studying your last two. I swim with tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Throughout this chapter, we've talked about timing differences, T3 slips, clearing accounts, and reconciliation. Now we're going to focus on a reality that every accountant eventually encounters in practice. The year-end arrives before all of the information arrives. At first, that may sound like a problem. After all, how can a corporation prepare accurate financial statements and tax reporting if some of the information is still missing? Yet this situation occurs all the time. Let's look at the timeline shown on this slide. On one side, we have the corporation's year-end. Perhaps the corporation has a February 28th fiscal year-end, or another non-calendar year-end. When that date arrives, the corporation cannot simply ignore it. Financial statements need to be prepared. Books need to be closed. Management may need reports. And tax reporting obligations continue to exist. The year-end creates a reporting requirement. However, on the other side of the timeline, we have the information providers, investment companies, mutual funds, and financial institutions are still gathering and processing information. The final T3 slips may not be issued for several more months, and that creates what we call the information gap. The corporation is expected to report today, but some of the information it would ideally like to have won't arrive until later. This gap is one of the defining challenges of investment income reporting for corporations with non-calendar year-ends. The accountant shown in the slide captures the situation perfectly. The year-end is today. The reporting work must begin now. But the T3 information may not arrive until months after the reporting date. So what should be done? Should the accountant simply wait? In most cases, that's not practical. The corporation still needs financial statements. The books still need to be finalized, and decisions still need to be made. This is why professional accounting is not simply about collecting information. It is also about making reasonable decisions when information is incomplete. Notice the 3 items shown in the problem box. At year-end, the corporation needs financial statements. It needs tax reporting. But the final T3 is not available. All 3 statements can be true at the same time. And that means the accountant must find a way to bridge the gap. One of the most important lessons in practice is understanding that year-end dates and information availability dates rarely line up perfectly. The reporting clock does not stop simply because information is delayed. Instead, accountants must work with the best information available at the time and be prepared to reconcile and refine that information when additional details arrive later. That idea sits at the heart of everything we've learned in this chapter. The reason we discussed estimates, reporting options, reconciliation procedures, and clearing accounts is because all of those tools help accountants manage this information gap. The key takeaway from this slide is simple. The corporation's reporting deadline and the availability of complete information rarely occur at the same time. As a result, accountants must often prepare year-end reporting using incomplete information while maintaining a process that allows future reconciliation when the missing information finally arrives. And that balancing act is one of the most important professional skills in accounting and tax reporting. In the previous slide, we saw the challenge that accountants face when a corporation reaches its year-end before all of the investment tax information has arrived. Now the question becomes, how do accountants deal with that situation? The answer is professional judgment. Professional judgment is one of the most important skills in accounting. In fact, many people assume accounting is simply about recording facts. But in practice, accounting often involves making reasonable decisions when every fact is not yet available. This is exactly what the balance scale on the slide represents. On one side, we have reporting requirements. The corporation needs financial statements. Tax returns may need to be prepared. Deadlines continue to exist. Management still requires information. The reporting obligations are real and cannot simply be postponed indefinitely. On the other side, we have the information that is available at the time. There may be bank statements, investment account statements, working papers, partial tax information. Perhaps some T-slips have arrived while others have not. The accountant's responsibility is to balance these two realities, and that balance is achieved through professional judgment. Notice the statement in the accountant's thought bubble. I don't need perfect information. I need reasonable information. That idea captures the essence of year-end reporting. Perfection is rarely available. Reasonableness is often achievable. The goal is not to know everything. The goal is to make the best possible decision using the information currently available. The decision process shown on the slide provides a useful framework. The first question is, what information do we have? Before making any decision, the accountant gathers all available evidence. The second question is, what information is missing? Understanding the gaps is just as important as understanding the facts. Next comes an important professional judgment question. Can a reasonable estimate be made? If the missing information can be estimated using reliable evidence, then a reasonable estimate may allow the reporting process to continue. Finally, the accountant asks, how will this difference be reconciled later? Good accountants are always thinking ahead. They know additional information may arrive in the future, and they plan for how those future adjustments will be handled. This forward-looking mindset is what separates professional judgment from guessing. Guessing has no support. Professional judgment is based on evidence, documentation, and a plan for future reconciliation. That is why the items in the reporting box are so important. Good year-end reporting requires documentation. It requires consistency. It requires reasonable estimates when necessary. And it requires a commitment to future reconciliation when more information becomes available. Perhaps the most important lesson on this slide appears in the memory box. Accounting is not about waiting for perfect information. If accountants waited until every detail was known with certainty, many financial statements would never be completed on time. Instead, accounting is about using the best available information and applying sound professional judgment. This is especially true when dealing with investment income, T3 slips, non-calendar year ends, and timing differences. The accountant's role is not to eliminate uncertainty. The accountant's role is to manage uncertainty in a reasonable, supportable, and well-documented manner. The key takeaway from this slide is simple. Professional judgment helps accountants balance reporting obligations with the information available at the time. By using the best available evidence, documenting assumptions, and planning for future reconciliation, accountants can produce reliable year-end reporting even when some information is still missing. We've now reached one of the most important ideas in this entire chapter. Throughout our discussion, we've explored many different concepts. We've looked at non-calendar year ends. We've examined timing differences between fiscal years and T-slip reporting periods. We've compared reporting methodologies. We've discussed reconciliation. We've learned how clearing accounts work. And we've explored the role of professional judgment. At first, these topics may seem unrelated, but they are all connected by a single objective. The objective is effective corporate tax reporting. And as this slide illustrates, effective reporting requires balance. Notice the triangle in the center of the slide. At the top is accuracy. Every accountant wants the most accurate reporting possible. We want investment income to be classified correctly. We want tax returns to reflect the best information available, and we want the financial reporting to be reliable. Accuracy is always important, but accuracy is only one part of the equation. The second corner of the triangle is practicality. In the real world, reporting deadlines exist. Financial statements must be prepared. Tax returns must be filed. Businesses need information to make decisions. Accountants cannot simply wait forever for perfect information. At some point, practical decisions must be made. And that brings us to the third corner of the triangle: available information. This is the reality that we've been discussing throughout the chapter. Sometimes all of the information is available. Sometimes it isn't. T3 slips may arrive after the fiscal year end. Investment information may still be incomplete. Certain amounts may need to be estimated and reconciled later. The accountant's job is to work with the information that exists today while remaining prepared to adjust and reconcile when additional information arrives tomorrow. This is why the center of the triangle is corporate tax reporting. Good reporting sits at the intersection of all three factors: accuracy, practicality, and available information. If we focus only on accuracy, reporting may never be completed because we are waiting for perfect information. If we focus only on practicality, we risk sacrificing quality. And if we focus only on the information currently available without considering its limitations, we may overlook important uncertainties. Professional accounting requires balancing all three. The chapter journey shown on the left side of the slide reinforces this idea. Every topic we've studied has been preparing us for this conclusion. Non-calendar year ends created timing differences. Timing differences required reporting choices. Reporting choices led to reconciliation. Reconciliation introduced clearing accounts. And clearing accounts ultimately highlighted the need for professional judgment. Each concept built upon the one before it. And together they create a framework for making sound reporting decisions. The Golden Rule box summarizes the mindset that professional accountants use every day. What do I know? What don't I know? Is my approach reasonable? And can I support it later? Those 4 questions are often more valuable than any single accounting rule. They encourage critical thinking, documentation, and defensible decision-making. Perhaps the most important message on this slide is the statement from the accountant. The goal is not perfection. The goal is reasonable and supportable reporting. That idea captures the reality of professional practice. Accountants are not expected to know the future. They are expected to make informed, reasonable decisions using the best information available at the time. The key takeaway from this slide, and from this entire section, is simple. Good accounting balances accuracy, practicality, and available information. When those 3 elements are combined with sound professional judgment, the result is reporting that is reasonable, consistent, and defensible. And that is ultimately the true goal of corporate tax reporting.